Welcome back to your trusted source for comprehensive global currency insights. Today, we turn our attention to a currency that, while historically underappreciated, is beginning to attract serious interest across global financial circles, the Vietnamese Dong VND. As of May 6, 2025, the VND stands at a critical inflection point, quietly reshaping its role in both domestic and international finance. For decades, the Vietnamese Dong operated largely under the radar of mainstream currency markets. It was considered a tightly managed, low-volatility currency with limited convertibility and relevance outside of Vietnam's borders. This perception, while once rooted in truth, is rapidly becoming outdated. Investors and economists who are attuned to the nuanced shifts in Southeast Asia are beginning to view the VND through a very different lens, not as a passive bystander, but as a potentially high-performing, strategically positioned asset in the emerging market sphere. Currently trading within a control range of 23,000 to 25,000 per US dollar, the Dong's apparent stability masks a deeper story. Vietnam's economic policy has long focused on maintaining tight control over its currency to ensure macroeconomic stability, limit exposure to external shocks, and support export competitiveness. The State Bank of Vietnam, SBV, has historically played a central role in setting the exchange rate, adjusting the official midpoint, while using reserves to prevent wild market swings. This control mechanism, while providing predictability, has also dampened the currency's responsiveness to Vietnam's economic fundamentals. However, 2025 is shaping up to be a year of transformation. In the first quarter, the SBV made a subtle but telling move. It adjusted the official exchange midpoint upward. While this numerical change was modest, its significance was substantial. Such a move is a strong signal of growing confidence in the strength of the Dong. More importantly, it suggests that the central bank may be testing the waters for a broader monetary policy shift, perhaps even a gradual move toward partial or full convertibility, which would represent a monumental change in Vietnam's financial architecture. This monetary evolution is supported by a backdrop of robust economic growth. Vietnam's economy has been on an impressive upward trajectory, outpacing forecasts and defying global headwinds. Over the past year, the International Monetary Fund, IMF, and the World Bank have raised Vietnam's GDP growth projections for 3 consecutive quarters. The country is benefiting from a diversified economic base, driven by resilient exports, subdued inflation, and a rapidly expanding service sector that is increasingly driven by innovation, technology, and e-commerce. The inflation rate, often a red flag in emerging markets, has remained consistently below 3%, a testament to effective macroeconomic management. In parallel, Vietnam's export engine continues to gain momentum. From electronics and textiles to agriculture and machinery, Vietnamese goods are now fixtures in global supply chains. This trade dynamism is further enhanced by the country's growing portfolio of free trade agreements, including its pivotal role in the Regional Comprehensive Economic Partnership, RCEP, which links it to some of the world's largest consumer markets. Foreign direct investment, FDI, is also playing a transformative role. Geopolitical tensions and rising operational costs in China have prompted many multinational firms to reconsider their Asia strategies. Vietnam, with its young labor force, competitive wages, improving infrastructure, and increasingly business-friendly environment, has emerged as a top alternative. The result is a steady influx of FDI, much of it targeted at high-value sectors like electronics, green manufacturing, and logistics. These investments are not only creating jobs, but also contributing to a surge in foreign currency inflows. As of May 2025, Vietnam's foreign exchange reserves have surpassed $120 billion, a record high. This surge provides the central bank with a powerful buffer, giving it the flexibility to defend the currency against external shocks and to take bold steps toward currency liberalization without risking financial instability. More than just a safeguard, these reserves give Vietnam the strategic leverage needed to realign the Dong's value closer to its market-based fundamentals. This shift is not theoretical. It's already being reflected in the behavior of global financial institutions. Across Southeast Asia, and increasingly in Europe and Australia, financial firms are offering improved rates for the Vietnamese Dong. In Singapore, Some private banks have started to offer investment products denominated in VND, a clear indicator that institutional trust in the currency is growing. This is a significant development, particularly for a currency that was once barely mentioned in the same breath as other regional players like the Thai baht or Malaysian ringgit. The growing legitimacy of the Dong on the global stage is matched by a parallel shift in domestic attitudes. Historically, many Vietnamese citizens were wary of their own currency, choosing to store wealth in gold, U.S. dollars, or other perceived safe haven assets. This behavior was rooted in past experiences with inflation and economic uncertainty. But that trend is now beginning to reverse. Increasingly, Vietnamese consumers are opting to save in Dong-denominated accounts, invest in local financial instruments, and transact digitally using their national currency. The real estate market offers a compelling snapshot of this change. In major urban centers like Hanoi and Ho Chi Minh City, property transactions are hitting record highs, with nearly all of them settled in Vietnamese Dong. This shift is not just a matter of convenience. It reflects growing public confidence in the stability and utility of the local currency. Even in rural areas, where cash has long reigned supreme, digital payment solutions and local banking services are gaining traction. Small businesses, supported by favorable government financing schemes and improved access to credit, are thriving, and they're doing so while operating primarily in Dong. Fueling this transformation is Vietnam's digital revolution. Over the past 18 months, mobile banking and fintech adoption have exploded. With more than 80 million smartphone users and some of the fastest-growing internet penetration rates in Asia, Vietnam is rapidly transitioning toward a digital-first economy. Fintech platforms are enabling faster, cheaper, and more transparent transactions, all of which contribute to the increased utility and credibility of the Dong. The digitalization of the economy is also promoting broader financial inclusion, giving more people access to formal banking systems and encouraging savings and investment in local currency. The implications are profound. As more transactions take place in Vietnamese Dong through secure, transparent digital platforms, the currency becomes harder to marginalize or dismiss. Its role in everyday life is becoming more entrenched, its usage more widespread, and its stability more visible, not just to Vietnamese citizens, but to international observers as well. Vietnam's deepening ties to the global economy further amplify these effects. The country's active participation in trade pacts and its expanding bilateral trade relationships are helping to normalize the Dong's presence in international transactions. Bilateral trade with the United States has reached unprecedented levels, and Vietnam's role as a key supplier to global manufacturers continues to grow. Each of these developments channels more foreign currency into the Vietnamese economy, adding yet more pressure to eventually revalue the Dong in accordance with its underlying economic strength. So where does this leave us in May 2025? It leaves us with currency that is no longer just a domestic accounting unit or a managed export tool. It is becoming a serious contender in global investment portfolios. While the Vietnamese government has not yet made a dramatic announcement regarding revaluation or convertibility, the direction is unmistakable. From institutional adoption and rising reserves to digital integration and shifting public sentiment, all indicators suggest that the Dong is evolving into a more flexible, more relevant, and ultimately more powerful currency. For investors, the message is clear. This is no longer a speculative fringe asset. The Vietnamese Dong is quietly maturing into one of the most promising currencies in the emerging markets universe. Those who take a forward-looking view, recognizing the convergence of macroeconomic stability, strategic reforms, and digital innovation, may find themselves well-positioned to benefit from a financial transformation that has, until now, been unfolding in relative silence. But silence does not mean stagnation. In fact, it may be the quiet before the surge. Should Vietnam continue along this trajectory and opt for a more open currency policy, we could witness one of the most significant monetary shifts in the region's modern history. And those who saw it coming early, those who prepared, studied, and invested with intention, may be standing at the threshold of a once-in-a-generation opportunity.